If you've been investing in Tesla, then you've probably watched your shares plunge to their lowest points in the past months, which begs the question whether Tesla stock is still a good buy. At a time when Tesla investors are torn between selling their shares or keeping them in hopes of a significant boost in the near future, Piper Sandler Research analyst Alexander Potter has something to say to investors, and he thinks they should be proactively buying Tesla shares at this point. According to the Tesla Bull, the company's price cut could boost demand to significant levels in 2023. Hey guys, welcome back to Tesla Tomorrow. Potter is a top Wall Street analyst on Tesla, with returns of around 8.80% higher than the S&P 500. The Tesla analyst wrote in a new note that Tesla's stock recent decline has reached attractive levels, and it's time for investors to start positioning for an upswing. According to him, Tesla took longer than expected to cut prices. But now that pricing adjustments have been made and the valuation has reset, he thinks investors should be proactively buying the stock. Is now the best time to buy Tesla stock? Let's find out. But before we do, if you like this type of content, don't forget to like and subscribe and ring that notification bell to keep up to date on everything going on with Tesla. Tesla's price cut has raised concerns about the company's margins. Following the perceived drop in the general demand for automobiles, which will likely be caused by a recession, Tesla has since responded with price cuts in major markets such as China, Europe, and the US. It has even slashed prices by as much as 20% for some of its vehicles. The recent price cuts moved Tesla's basic Y model down from $65,990 to $52,990, lowering the cost for EV buyers and consequently increasing demand. Potter's note pointed out that the discounts could be closer to 30% when considering the $7,500 federal tax credit for purchasing US-manufactured EVs. The analyst also cited that more affordable pricing could increase demand. Potter put an overweight rating and a $300 price target on the stock, labeling Tesla's price cuts as underappreciated. Alexander Potter has been a huge fan of Tesla and seems to remain bullish on the car company. The analyst had defended Tesla in the past when shares of the car company started the day lower by 0.59%. Tesla had anticipated a year-to-date loss of more than 60%, which will be the highest on record. However, responding to this, Potter cited that Tesla's stock has been in a tailspin for the previous weeks because bears and tax loss sellers were putting pressure on the stock to go down because of a steady stream of bad news. He also added that the situation with Elon Musk's Twitter business, the fast-changing rules about pandemics, and the outbreaks in China further intensified concerns about 2023. According to Potter, it is known that growth could easily slow down in 2023 because of issues such as recession, higher interest rates, and markets that are already full of Tesla products. But he does not believe that Tesla's market share is suddenly being eroded by a flood of new competition, and that the long-term thesis has changed at all. Not only did Potter keep his bullishness on Tesla, he also maintained a buy-equivalent rating on the stock and set a price target of $340, indicating that it may nearly quadruple. Likewise, in 2021, the Tesla Bull agreed and pointed out that Tesla redefined what is core for an automaker in the 21st century compared to what incumbent automakers believed it to be in the last century. Following the announcement of Tesla's price cuts in mid-January, several analysts had speculated that it was a move to combat weakening demand for its vehicles, and that may, in some way, be true since the cuts have helped Tesla lower inventory levels significantly in the United States, and when combined with government-backed incentives, could offer as much as $20,500 in discounts. On the other hand, Piper Sandler analysis believed that the sentiment from consumers behind the price cuts is not being fully recognized. The firm cited the price cuts could open the doors for 300,000 additional unit sales for the automaker this year, probably twice this amount. Piper wrote, "We don't think most investors appreciate the extent to which lowering pricing could support Tesla's market share. This is particularly true in the United States, where lower prices combined with a $7,500 tax credit could unlock at least 300,000 units of incremental demand, if not twice that." Potter noted that the price cuts could help Tesla poach demand from competitors like GM and Ford, all of which have chipped away at Tesla's EV market share in recent years. He also added that the US auto market has ample real estate for Tesla to exploit. Though the price cuts do look pretty bad, Piper Sandler said the company took longer than expected to make the changes. But since the pricing adjustments have been made, investors should be loading up on more shares. However, it is important to note that while Potter sees Tesla's price cut as a valid move, he still recognized that the price cuts would lower the company's gross margin, which was 27.9% in the third quarter of last year. He adjusted its estimates to 24.7%, adding that he is hopeful such a drastic decline may not materialize, due to deflating raw material costs and better margins in Tesla Energy. Alexander Potter also cut its price target on Tesla from $340 to $300. Tesla had numerous predictions on its demand for the year following its move to lower car prices. Needless to say, however, the demand is expected to respond positively over the next couple of months. Potter suspects that the margin profile of new capacity in Shanghai, Austin, and Berlin is already higher than many expect. No doubt, Tesla is actively ramping up its facilities, which will likely build more factories to meet its goal of 20 million EVs by 2030. According to the automaker's CEO Elon Musk, Tesla will probably produce 20 million electric vehicles a year before 2030. Musk said he expects the electric vehicle market to produce more than 30 million new vehicles annually within the next 7 years, adding that reaching this within 5 years is possible but unlikely. Musk's audacious goal of selling 20 million electric vehicles in 2030 is the center of the company's growth promise for shareholders and its pledge to drive the adoption of sustainable energy. This figure is more than 50 times the number of vehicles it made in 2019. If that goal is achieved, this could make Tesla twice the size of any automaker in history, accounting for roughly 20% of the global vehicle market. The car company's been a disruptor, but this next phase could fundamentally remake the global auto industry, as well as the mining and trade of new batteries. For that to happen though, Tesla needs to build 7 or 8 new gigafactories, an average of 1 every 12 months, about 30 times as much battery capacity to supply all of its vehicle factories. Tesla will also take share from every competitor and emerge as a company the size of Volkswagen and Toyota Motor Corp combined. Although Musk has said that reaching this milestone is going to require a lot of work, Tesla is already making plans. The automaker has begun signaling offtake agreements with miners and refiners and already has deals with more than 20 material suppliers around the globe. While the raw material capacity needed to support Tesla's planned production in 2030 does not exist today, the automaker is finding ways to make them available. In its note, Piper Sandler stated that Tesla can now easily achieve at least 50% delivery growth in 2023. The automaker had planned to grow sales by more than 50% last year, compared with 2021, despite supply chain issues. According to Musk, 2021 was a breakthrough year for Tesla, and for its EVs in general. The CEO of Tesla also added that while Tesla battled with supply chain challenges throughout the year, it managed to grow volumes by nearly 90%. Elon Musk had expected that Tesla will comfortably grow above 50% in 2022 despite supply chain constraints, which was its main limiting factor. Probably this figure is going to be achievable by next year. Although Alexander Potter cut gross margin expectations to adjust for Tesla's low profit margin per sale of its vehicles, he also argued that lower margins might not be as bad as many investors fear. It is important to note that while Tesla's price cut may help demand, the automaker was not in any condition to push prices downwards, as demand was healthy and Tesla was already finding its way through supply chain bottlenecks. Although it's not certain what the future holds for the automaker, there is indicators that Tesla will record impressive figures for its demand and sales in each quarter of 2023. But what do you think? Do you think Tesla investors should buy more shares at this point? Let us know down below, and also let us know what your valuation of Tesla is. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.